Hello, hello, hello. Welcome now, Stock Trades. This is going to be a very quick one. This is in response to essentially today's earnings report. Just wanted to I had some time to think about the earnings, and I went ahead and listened to the Q&A section again, just on my own time, without having to manage the YouTube live. I'm not going to lie to you guys. There was a lot of trolls on there, just causing chaos and. In the future, I may limit the YouTube lives that get that big to maybe charge $1.50 or something, just to cut out the trolls. But who knows? Maybe they might enjoy this trolling for 50 cents. So it's actually very difficult for me to focus a little bit. So I want to remake this live to basically talk about what's going on. Okay. So how you doing, Sean? Hello, hello, hello. And how's everyone doing? Okay. So let's go ahead and just kind of recap real quick what happened. So, Q3 2023 earnings, the MCR improved 78.5%, bringing the year-to-date MCR to 80.8%, which is good. The insurance revenue grew 12% in comparison to actually what it grew a quarter ago, which was 17%. So there was a net loss of $41.5 million. With the adjusted EBITDA loss of $5.1 million. There was an adjusted EBITDA profit of around approximately $10 million from last quarter. So what it seems basically from the service analysis is that this quarter was a little bit more deadlier or a little bit more harder on Clover to manage, okay? So the revised full year guidance was 81 to 82%, and this is kind of the negative parts of the adjusted EBITDA, okay? So just very quickly in more table form, we can see that, like I said, the insurance revenue grew 12%. There was a decline in non-insurance revenue because their goal was to focus on physicians that are Clover assistant-centric. But this argument does not make sense anymore because their non-insurance MCR literally remained the same, a difference of 0.1, which is a magnitude that is insignificant, okay? In comparison to the revenue they cut. So this means non-insurance MCR is not working for them. It is killing them. It is not, it's not a business model. Okay. So they acknowledge this and they say that they're going to reduce their exposure to non-insurance MCR finally. And I'm going to give you my analysis on this, like my opinion, I guess, right? You can call it my opinion on the non-insurance MCR. Okay. And, they said that there's a different section of the non-insurance MCR that they are tackling, and they haven't released the lives for that. So potentially they may have found a pattern after cutting these people that they may succeed in something different than what they unintentionally did. So we're going to hear more about this. But from the data I have, this non-insurance MCR is not working. And the thing is, lots of people told Andrew Toy that non-insurance MCR is just not, it's a very difficult business to get into. The way that, the whole thing is structured, it's very difficult. But he insisted to continue with this, and to a point where his company is literally failing from this perspective, okay? So now he basically sees the writing on the wall. Profitability is here. If you don't meet these metrics and prove your business model, you will be sent back as a private company and you'll leave Wall Street. Okay. He got the message and he got the hint. Okay. So I expect this to 2024 and 2020, especially in 2025 when they have 3-star rating. I expect this to essentially get bye-bye, right? Or at least improved because it's very clear now. So now that we got the elephant out of the room, let's talk about the good. Again, I wanted to focus on the bad first, and then I'm going to do the good, and then I'll do one more bad, which is actually a good. I know that sounds confusing, but it'll make sense. So if you look at the insurance revenue and the insurance MCR, ladies and gentlemen, I know this reduction doesn't do it justice. So this is like quarter over quarter. So let's go ahead and just one of our members here posted this graph here. So I think this is great. I was going to create something a little bit more longer, but again, I think it's a year out. So you would have to go to the SEC filings to do that. But again, You can see from a long-term perspective, MCR is going down, okay? From a revenue perspective, this is quarter over quarter. Revenue is going up. From a net income perspective, they are improving, okay? Again, this is kind of a little cute diagram. I like it. What I want to basically show you now here, just extension of that thought. From the insurance perspective, this company is improving. It went from 107.9 to 111% MCR, insurance side, to around approximately 81 to 82%, literally 77 to 78.5. Their business model works. This is very hard to do. Do you think the Clover Assistant works? It does its job. This is proof of it. The problem is they cannot be successful in this line of business. The non-insurance MCR, they said that they may have found something within the non-insurance MCR that helps physicians. If they can activate this source of revenue without having to lose money, then that's what they need to do. As a CEO right now, your house is burning, you're losing cash, and time is ticking. It's very clear now. I think with this earnings call, he got the point. This guy is about to crash his company, and he only has a couple more quarters, let's say a year, 2-3 years, to basically make this correct. And if he doesn't, he's gonna destroy his company, and then his legacy and everything he's ever worked for is going to be remembered like this. Okay, so he got the point. Well, what I'm trying to say is, I listened to him. He got the point. Okay, it's very clear that this is an issue, and it finally reached his hippocampus. His software is not able to tackle this. Maybe perhaps the software part is not working for non-insurance, but it's working for insurance. Maybe perhaps the way the non-insurance MCR is built, there's actually a flaw in the healthcare system that not even an AI model can fix it. Makes sense. We have a broken healthcare system. Okay. But the insurance MCR, it's working. It's working. I'm going to say it again. It's working. Okay. All right. So that is what's going to happen. Okay, now let's talk about retail investors. Okay, so let's look at smart money, dumb money. So dumb money recently spiked up, and now it's basically leveling off. Okay, Wall Street's trying to hold the brakes a little bit on this rally we had last week and the beginning of this week too. And interestingly, I saw a lot of negativity just over one quarter. Okay, ladies and gentlemen, this is good. Okay, for all the people that are watching this video, great. This is good. Okay. There's not a lot of retail investors out there that hold CLOV that are watching this video. And this is great. Let those people, let them sell. Okay. Let them sell. Let them get out. Okay. This is great. This is how you cycle between high institutional investors and low retail investors in a company. Okay. The more retail investors get siphoned through and sell, the better the stock is going to end up being. Okay. A lot of retail investors are short-minded. A lot of them have this thing. I see it on the Reddit page, like, oh, we're going to hit profitability this year. Some people are going to think that we're going to hit profitability in Q4. We're not going to hit profitability this year. Like, I don't understand if you don't see the numbers here, right? The numbers do not scream profitability. We're not going to hit profitability in next year. We're going to hit adjusted EBITDA profitability. See, that's the reason why I built the Mastering Stock Market course. It's because people's understanding of finance is just so fucked. Like, they don't understand what these words mean. And then when it doesn't happen, they just basically spew just garbage into the, community, which is fine. It basically shows you that you're always going to make money in the market because there's always going to be people that are less educated than you are that you can that pay money like like a rich man, and they'll lose their shit because they sell because they realize that it's someone else's fault, not theirs, which is fine. Take advantage of it. People are selling. I'm buying their shares. That's great, right? But the biggest thing is they are going to become adjusted EBITDA profitable in 2024. The biggest thing is they're going to become free cash flow profitable. Okay. Now, I don't think this updated yet, but I'm going to check. I'm checking right in front of you. Okay. Okay. So let's go ahead. Let's open up master. No. Let's open up the help menu. Okay. And let's open up stock fundamentals. Okay. Let's look at the quarterly financials. Huh? Let's look Clover Health. Okay. Let's go ahead and we downloaded the file from the stock terminal. So here is this. So as you can see right now, we're still in Q2. The system hasn't updated yet. Okay. But what I do want is I want us to look at these first two quarter. These wait a minute. What is this? Q3 2022. What is it technically? So we can just go ahead and take a look at these here. That's fine. I would have to look at this again. Yeah. Let me double check. Oh, okay. CLOV. Let's take a look at this real quick. Make sure I get these numbers right. Quarterly cash flow, free cash flow. Yeah, of course, they don't tell you the thing. Okay. Yeah, see? Yeah, so around, let's call it 78, which is right around my calculation. So what I was basically trying to do right now is I was trying to calculate the free cash flow. The system hasn't updated on my end right now, okay? So as I did this, like I said, we're estimating it at around 70-ish. We did the estimation today, okay? But now let's grow it at the low 12%. If we grow it at the low 12%, we get around $4.34. They still have the non-insurance side that he was talking about, and they also have the Clover Assistant that they can monetize. Okay. But what I'm basically saying right now is it's sitting at $1. This is still good. You know, my average is way below well, I would say it's more close to the recession, right? But overall, this is really good. Okay. So based off of this right now, if they grow at 12% based off of just their non-insurance side, it is still undervalued. We're talking by 339%. Okay. But the biggest thing I want to focus on right now is this here. Okay. If you look at the Medicare Advantage by firm and or affiliate, look at United Healthcare. For the past, this is Medicare Advantage. For the past, since 2011 to 2023, look at their growth. Look at Clover's growth. Clover's growth, they are out-competing United Healthcare, Humana. They're killing all of them. All other healthcare insurance, they're killing all of them in terms of the Medicare Advantage. They are enrolling 12% year over year. They are, in terms of the revenue, their lives and revenue is two different things, right? Their revenue is actually growing more than their lives, which shows you that this MCR that we're basically stressing here, and the Clover Assistant, where the hell did it go? This Clover Assistant's MCR decrease of 1,000 basis points and more is working. It's doing its job. Okay. So this is what makes me happy. Okay. Now, very quickly, let's go to the next slide here. Now, again, what happened in 1971? There was a divergence in productivity and compensation. Okay. Why did this divergence happen? Okay. I did a write-up on it on the stock terminal, but in a just very short terms, innovation, technology, internet. Now, the question is technology and AI and machine learning going to make this worse, making the people that get paid for their work to stay the same? Yes. Okay. Which is why you need to invest, because if you are the owners of production, then you will make the money versus the workers of production. Okay. So how do you find investing companies? And, it's invest in technology. Okay. So that's pretty much all I have for you guys. Just wanted to take a look at this and dissect it. We spoke about the non-insurance MCR. We spoke about the insurance MCR. We spoke about how this is poison. This needs to be removed or modified. They understand this now, and they understand the assignment. Okay. Now, just very quickly, the CMS $140 to $50 million payment they have to make. The Bank of America analyst, I agree with him. Good question. And the answer is, I believe I need more data on this lawsuit. I don't see it here. I need to look at their quarterly SEC filings to see if they disclosed it there. But they did say they have an upcoming lawsuit. Again, they don't have to technically disclose those until a certain amount of days. So we should hear about this. I think they just wanted to say it in person first to make the blow a little better. But the beautiful part about this, though, is that this lawsuit from CMS, they are going to still be able to be free cash flow positive in 2024 and are still not having to raise capital in 2024 and beyond. So that's all I care about. They can have 20 million lawsuits. I don't care. Okay. They're able to become profitable by free cash flow next year. That's fine by me. Moving on. Okay. So, very quickly, if you want access to our exclusive access to Billionaire Insights, Chamath Edge, there'll be a link down below. If you want access to our Stock Terminal GPT, it's AI enhanced analysis, ask and invest, data at your fingertips. You can go to stockterminalgpt.com. That's stockterminalgpt.com. And that's all I have for you guys. I'm very excited for this journey, and this is going to be really well. Okay. I'll see you on the next one.